Alright guys, so you are welcome to the Faith Trader channel, and where profit meets purpose. And when you read the Bible in Matthew chapter 7, it tells us that a wise man built his house upon a rock. So when the rain falls and the wind blows, it still stands. Many traders begin, but they don't end up well. In fact, most traders jump into trades without any solid foundation, and they end up blowing account. They become emotional and blowing accounts left, right, center. And you see, and if you are feeling confused and overwhelmed by the noise in the market, I think this video is going to help you build a strong understanding and of market structure. So this is basically the basics, and I believe that we are going to grow from there. This is the first video. There's going to be more videos along this line to help us understand market structure very well. So let's jump straight into the chart. Now, when we talk about market structure, what comes into mind is we have three kinds of markets. Okay, we have the bullish market, we have the bearish market, and we have the ranging market. That's the consolidation, right? Now, so as I'm showing right here now, when I talk about bullish market, let me mark it right here. So let's talk about the bullish market. Bullish market. All right. So since it's bullish, let's use this color, right? So the color blue, right? Now, so when I talk about bullish market, we are talking about market that moves to the upside, right? So we're having a move like this, right? A move like this. Okay. Powerful. Now, one thing you must understand is that market doesn't move, okay, in a straight line like that. I see it. Yeah, so this is the mistake a lot of people are making. They think that market will just be going up without any retracement. That's the mistake right there. So some people realize that one of the mistakes they do is that they realize that price goes into their favor, and when price tries to make a retracement out of fear, they will just close the trade and they will miss the actual move, the continuation move. Okay, so that's not how to approach the market. Now, what market does is that market makes so let me mark it over here. So we have the higher highs, okay, and we have the higher lows. Okay, so it goes like that. Now, higher highs, higher lows, higher highs. Okay, let me put it right here. Okay, so we are seeing it over here, right? So we are seeing higher high, higher low, higher high, higher low, higher high, higher low, then another higher high, right? Now, so this is the basic structure for the bullish market. Okay, so because price is moving to the upside, it makes higher highs and it makes a higher low, higher highs, higher low, higher high, higher low, higher high. Now, let's put this one aside like that. Okay, now let's come to the bearish market, right? The bearish market. Now, we're talking about bearish market. We are talking about price moving to the downside. Okay, moving to the downside. Yes, moves into the downside like that. I see it. So what price also does is the price makes a higher, makes a lower high. Okay, and you see a lower low. Okay, to make another lower high. Yeah, so it goes like that. You get it. You get the idea, right? So lower high, lower low, lower high, lower low, lower high, lower low. Meaning that the lower low. So for example, now that we're in lower low, what do you think price will do? Price will make a lower high. Sorry, make a lower high, then dump for the continuation, targeting probably the sell side liquidity. Okay, now I don't want to confuse you much. Talking about liquidity, I'll come there so that you get what I'm talking about. So you see this is the bullish market. Let's give this red. Now this is the bearish market, right? I hope you get the idea. Okay. Now let's look at the ranging market. Let's clear all this. Let's clear everything. Okay. Let's clear everything. Okay. All right. Now let's talk about the ranging or the consolidating market. Okay. So when market ranges, then what it means is that market is either not making a lower lows or lower highs, right? Or probably market is not moving at one direction. Probably if market is going up, you see it's making some high highs, high lows, highs in it. But basically what the ranging market does is that ranging market goes like this, right? Highs in it. In the more of a consolidation, highs in it, where you don't know if price is going up. Yeah. So usually what it does is that you see price making something like this. Okay. Yes. Then it will come back, come to that same level and come back, retraces from this level as well. Okay. You get the idea, right? So basically I see market doing this. So you see the high highs, but you realize that it is bouncing, giving that ping pong effect, right? Not knowing whether price wants to go up, continue to make an expansion or not. That's a ranging market. So with this market, I think it's not advisable to trade. I personally, I don't trade the ranging market, right? So when price is ranging, I'm out. So I come in when there's a strong expansion, given clear directional bias. Okay, that's when I'll enter in, and we are good to go. All right. Now, I want us to talk about something amazing about the same market structure. Now, I want to talk about something called liquidity. Okay. Now, let's talk about the buy side. So we talk about the um, buy side liquidity, and talk about the sell side liquidity. Okay, let's mark this one to as red. All right. So what is buy side liquidity? Okay, so you can have markets moving in an upward way, right? So higher highs, higher lows. So one thing you realize is that you see every high is in it, and every low can become a liquidity grab, okay, or can become a liquidity point. Now, when I say we are targeting buy side liquidity, it means we are targeting the higher highs, right? So if price, let's say, price is wants to make what's the name? Wants to reverse, eyes in it. So at time, what price can do is that price can just come in, take out this liquidity, make a change of structure, okay, or probably change of state of delivery, right? Then we'll dump, right? Targeting another side called the sell side. Okay, let's mark with this a dollar sign. So let's mark this one with the dollar sign. Okay, so this is a clear example of the buy side liquidity, and this is a clear example of the sell side liquidity. I saying something, yeah. So with this case, we can say that price changed, made a what market structure shifts. Okay, now what do I mean by market structure shifts? Now, market structure shift, okay, meaning that the market is changing. If it's on the bullish side, you see something like this, like probably a high, high, low, high, high, then you see a lower low. You see, So for example, I'm going to mark it for you. So um, so you can have high, high, low. So high, 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 low, higher, high. So let's put this one over here. Let's make this so higher, high, right? Let's give it that blue. Yeah. So higher, high, higher, up, low, right? Then we see higher, high. Then all of a sudden, we are not seeing a higher low. You see, if it's a higher low, then price will come like this, make a higher low, then continue and make another higher high. But price, when price is reversing, at times price doesn't do that. Okay, so what price does is that price after price has taken this buy side liquidity, okay, and price takes this higher low. All right, what happens is that this break becomes a what change in what um, becomes a market structure shift. All right, so let's make it like so, market structure shift. All right, powerful. Now, meaning that price is ready to make a reversal to the what, to the sell side, meaning that now that price, so price makes something like this. Okay, so price, so we were on the bullish side, right? But right now price changed structure, meaning that price wants to now start moving downwards like this, targeting, as I said, this sell side liquidity, right? So let's mark it again. So right now we have high, 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 low, high, high, and you see a lower low. Okay, and you see a lower high. Okay, you see another lower low. You get idea, right? Another lower high, lower low. Okay, then lower high. You get idea. You see, why is it making the lower low, lower high? Because the market has what shifted. There's a market structure shift. Okay, at this side. I see. So we have, so this becomes the buy side curve. Okay, and this side becomes the sell side curve. You get idea. So the buy side curve ended when the market changed structure at this level. Okay, then we started aiming the sell side liquidity. I hope it's clear. Yeah, so I'm trying to make things as simple as possible for you guys. All right, so this is basically what's the name, the change, that's the market structure shift. Right now, some people call the market structure shift, I think the SMC traders, so SMC traders call it the choke. All right, the choke, right? Yeah, so it's the same thing, right? So times people call it choke, so the SMC traders call it choke. Now ICT traders um, call it the change in state of delivery, call it the change in state of delivery, CISD, right? Which is the same thing. Okay, you get an idea. Yeah, so when you see something like this, it means market wants to shift from one side of the curve to the other side of the curve. I see it. Very good. Now let's talk about advanced structures. Okay, you see, all this that you are seeing, that's not how this is like the skeletal framework that I'm giving to you, but when you come to the chart, you see something different. Okay, you see something different, and I'm going to show you something very soon. Now let's talk about liquidities. Okay, I'm going to treat that as a separate video, but I want to touch on it in terms of market structure. Now, so you can have a buy side move. Okay, let's say we have a bullish market, so we have a higher high, higher low, higher high, higher low, eyes in it, higher high. Okay, then price will come and take this low, eyes in it. Yeah, price will come and take this low and continue. You get the idea? Yeah, this is how a lot of people lose their monies, right? Yeah, because they are not looking at the higher time frame. Okay, so probably they are thinking that, oh, this is a high, 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 low, high, high, higher what, higher low. Meanwhile, this is not a higher low. This is what, a liquidity grab. Okay, so this is the liquidity. So price just wanted to take some liquidity. Okay, to fuel the buy side. Okay, yes. So at times, to for you to identify a valid, what's the name, a valid break of market structure. Now, you see, when market makes high, 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 low, high, high, you see, this becomes a break of structure, which is the BOS. Okay, which is the BOS. So this also a BOS. Okay. Now, I won't say this particular is a BOS, okay, but let's say price is giving us this structure. Now, I want to just explain something for you. What makes a strong break of structure? Okay, this is not changing what's the name, market structure. No, that one is MSS, right? That's the market structure shift. So there's a difference between the BOS and there's a difference between the MSS, right? That's the market structure shift. So this becomes the breaking market structure. Okay, and this becomes the changing market structure or market structure shift. Okay, meaning that it's shifting from what, from bullish to bearish. You get it. So this one, the breaking market structure is when price break the high. Okay, so remember I mentioned this becomes a higher high. Okay, you see, when price breaks the high and comes and mitigates probably another block, a fair value gap, then continues and break another high. I see some. So this is a clear definition of a bullish market when the highs are broken. Okay, yes. So when the highs are broken, price make a retracement, and another high is broken. You see, so this high is broken. I see. So therefore, we get a BOS. This high is also broken. I see. So therefore, this becomes a BOS. So this high is also broken by this bullish leg. So therefore, we have another one right here. Okay, and this bullish leg breaks this high. Then you see, sorry, then you see the BOS right there. You get it. So what you have to do is that you have to be very careful on identify and probably strain your eyes to identify if price is coming to take liquidity, okay, to fuel the buy side move. I saying something. Remember I mentioned that every high is a target for buy side liquidity. You see, all these highs are liquidity grab point, and every low is also a liquidity grab point. I saying something. Yeah. So what makes a break in market structure very strong? Okay, meaning that, you see, for example, we have order blocks, right? So you can have an order block right here. Let's name it as an order block. Order block. Okay. Let's put this one aside. Okay, so this is another block right now. What gives you a strong confirmation that okay, the high, that bullish leg is going to break the previous high? I say, for example, you see, for example, we have, let's say this is another block, right? What this other block becomes a high probability. Okay, it becomes a high probability on that block because you see this leg, okay, this bullish leg took liquidity before it broke the market. It broke the it made a break in the structure. You get it? So price took the liquidity before it broke. So therefore, it makes the other block, any other block that is created at this point, becomes a high probability other block. That anytime price comes back, okay, or make a retracement, price would want to come to this other block, or probably you can have an imbalance right here. Okay, a fair value gap, which I'll make another video for. So price will either, so it's two ways. Okay, at times what price does, the price will mitigate the what's the name, the fair value gap and make the expansion, or price will mitigate the fair value gap and come back as it will make another retracement as though it's going to continue, but reverses and comes and mitigates the other block. Why? Because this other block is a high probability other block. Why is it a high probability? Because it took liquidity before it broke the structure. You get it? So when price make a retracement, price will want to come to this other block, eyes in it, come to this other block and boom, price comes and what breaks the structure, aiming the buy side liquidity, targeting the high side as well. Eyes in it. So with entries, so what people do is that since you don't know if price will come and mitigate a fair value gap, or we have the aggressive entries. Okay, we have the aggressive entries and we have the other entries where you go for more confirmation. Okay, now I know people who, when price comes to the high probability on that block, they'll just take a long at where the fair value gap is. Okay, and as I mentioned, one of the another attribute of a strong order block is when there's an imbalance before the order block, it makes it even stronger. Are you saying it? Yes, it makes it stronger. So the order block that takes liquidity, and when in the process of the expansion, it creates an imbalance. That's the fair value gap. I say that other block is a high probability, meaning that when price visits it back, okay, price will dump. I say something, price will dump. So usually what people do is that they will just put they will enter. See, when price gets into the order block, so enter into the fair value gap, and you will put their stop loss just below the order block like this, aiming a 1:2 risk to reward, or 1:3 risk to reward. You get it, then you are good to go. So this for the bullish, these are the bullish market example. Okay, this is the bullish market example. Yeah. So with the bearish market, you just take the same thing and you flip it. You get an idea? Yes, and you flip it. It's quite amazing. So as I mentioned, I'll be talking about liquidity, liquidity graphs and all that. At times, market is quite amazing. It can make higher highs, higher lows, higher highs, and to make some small retracement. I saying it to make some small retracement. You may think that price is trying to reverse downwards, but what price is trying to do is that price is trying to engineer more liquidity. I saying it. Yeah, price can make an inducement. Yes. So price, for example, high, low, high. So high, low, high, low. You get it. So these lows, you see this relative equal lows becomes a liquidity pool. So when price comes up a bit, price will come and take out. You get it. This becomes liquidity zones. Okay, yeah, it becomes a liquidity zone. Okay, so you can have your order block. You can have your order block. So price comes, mitigates the order block, and boom, you see price will just rally. You get idea? Yes. So in identifying directional bias, you must first of all ensure that your higher time frame direction is in line with your lower time frame ISNet, so that you don't fall a victim thinking that such structure probably price is making a change in, it's not making a change in state of delivery. Price is just trying to go for liquidity grab so that it can forward the buy side liquidity. You get it? Mhm. All right, guys. So I want to show you on a real chart. So we are still on XAUSD. Now, you can see clearly, okay, that we are on a bearish leg. Okay, price is moving on a bearish leg. Okay, meaning that it's making lower lows and lower highs, lower lows and lower highs, right? Now, remember I showed you something concerning the liquidity point, okay, where price tends to take liquidity to fuel its move downwards, especially when we are having a bearish bias, okay. All right, so when you check this structure over here, you see, when you check this structure over here, what you realize is that you may think that price is making a change of state in delivery, so therefore we are going to have price moving towards the buy side, which is a very big mistake. A very big mistake. Okay, why am I saying that? You see, remember I told you something about the high probability order block. Now when you realize, when you check this order block over here, okay, let me label it order block. Order block. Okay, yes. And remember what I said about order blocks. Okay, the high probability order blocks takes out liquidity. So let's give it a dollar sign. It takes out liquidity. Are you following? So this particular order block took out liquidity. And remember, we have a fair value gap here as well. We have our imbalance, fair value gap, right? Remember what I told you concerning our previous, what I spoke about previously. I made mention of the fact that the high probability order block, what it does is that after it takes out liquidity, it becomes a high probability point where price will come in, mitigate, and continue downward, targeting the buy side. The sell side liquidity. You get it? Yeah, targeting the sell side liquidity. So you can see from here that if you are making an attempt to buy, thinking that, oh, price came in like that, made a change of state and delivery, so I'm coming to buy. So therefore, uh, I'm gonna take a buy over here, okay, and aim the what the buy side liquidity. You are making a very big mistake. Yes, this is a no, a no, no, no. Why are we saying that? Remember I mentioned that the bias is bearish. The bias is what is bearish. Okay, the bias is bearish. So price can either make a turn from this fair value gap, and in most cases, what price will do is that price will rather come in, mitigate the order block. Then realize that it will make an expansion lower, creating an inverse fair value gap, which we'll talk about in our next chapter. This is going to be in the form of a series. So yeah, there's a lot I'm going to talk about. So price will make the expansion low, make a retracement and retest the inverse fair value gap, then boom, we are having our continuations where towards our, let me give you the dollar sign, towards our sell side liquidity. So if you are targeting a sell, remember we are in a bearish leg, right? So all you do is that you take out your position over here. Your stop loss is placed a bit above the order block right here. Then you can aim 1:3. If you are more of a risk taker, you can go more to taking 1:6. Yeah, 1:6, and you can be you can be breaking even and do your risk management and all that, so that you don't lose your profit when price make a huge retracement. Okay, remember, risk management is very important. And so you can see price is really moving. You can see price moving right here. So what is price doing? It is aiming where? The order block. Now remember, it's going to mitigate, then boom. So this is a live session actually, but this is just for an example to show you how the market structure works. Okay, all right, so this is the Fit Trader. So subscribe, hit the notification bell, like, and you can share with your friends as well, so that they can know all about market structure. If some of your people are confused, they can also get clarity as well. So we'll be giving you more content like this. So I think we are done for today. So have a nice day. Peace out.